Hey guys, do you want to double your entire savings account in 1 year? Or even triple it? Stay tuned, watch this video to the end. I'm going to show you how. And smash that like button for me. Hey YouTube, back with another video. It has been a while since I uploaded, I realize this. Just had another idea for a video though, and thought might as well throw this one on there. And to some of you this might be obvious, but it's the way that you need to think when you're buying a stock. What is a stock? A lot of people use the stock market like gambling. I'm realizing this more and more with my friends and family and people I know that are investing. They're buying because they think that the number that they're paying is going to go up for whatever reason. And that's not really what you should be looking at when you're buying into a company. What you need to understand when you're buying an asset or a company is you're actually buying the business. You might not own the entire business, but you're owning a portion of it. So think of it like you and 10 of your friends get together and all of you are going to spend $100,000 each and you're going to buy a business for $1 million. So you know that you've paid $1 million for that business. Even though you might have only paid $100,000 of it, you know that you bought the business collectively for $1 million. That's the exact same thing with the stock market. When you buy a share in a company, you and a whole bunch of other people are paying a certain price for that entire company. And that's the way that you really have to look at it when you're valuing the company. So back to the illustration with your 10 friends, you're all buying it for $100 million, or for $1 million, sorry, 100,000 each. Well, let's say the company has 500 million, let's say 500,000 in the bank and no debt. And they make, let's say 500,000 per year profit. So you and all of your friends bought this company. You all paid $100,000 each. You paid $1 million collectively. The company already has 500,000 in the bank, so that automatically gives you back half the price. So now collectively you have all spent 50,000. You've instantly made money. This company makes 500,000 per year profit. So you know that in 1 year, that next 500,000, your 1 million mark is already paid. The company has generated 500,000. It already had 500,000 in value. That's now your 1 million price. You've already made your money back. Everything after this that the company makes, it's profit. That is all going to you and your 9 other friends. And that is exactly the way you need to think when you go to buy a share of Apple, Amazon, Disney, Visa, any company, any stock at all. So you just have to realize that you're buying a portion of what the company is worth. That is called the market cap. So you and your 10 friends that spent the $100,000 each, your market cap would have been the $1 million mark. You paid $1 million for the company. Now, it's exactly the same in the stock market. You need to look at the market cap because that's the price you're paying total. You and all the other people that own this company out there are paying that total price to own that portion of the company. And then, now that you know how much you're paying for the company, you need to figure out how much it's worth. So in my illustration, the company had 500,000 in the bank already. So look at the balance sheet and figure out how much does Walmart, Apple, Disney, whoever it is that you want to buy into, how much money do they have in the bank? And how much debt do they have? You need to subtract that debt from the money they have in the bank and the value of their assets. That's going to give you kind of an idea of what the company's worth. So now you can see how much you're paying for it in relation to, so like you don't own the whole business, but you're paying the market cap for your portion of it. And you're going to be able to figure out how much that company is worth with their debt and their equity and how much money they're going to make future cash flow. So in my example, they made 500,000 profit per year, which, you know, that's a no-brainer. Anybody would buy a company that has 500,000 in the bank and makes 500,000 a year and you're paying $1 million for the company. Yeah, you're going to get a lot of money real quick. But that's what you're looking for. That's exactly what you're looking for in the stock market when you want to buy a company. You want a company that is going to make all of your money back in a short period of time. They're very profitable. You want a company that you're definitely getting a good deal on. And that's literally all there is to it. So don't think of it like you're going to buy Wells Fargo today at $25 a share because you think next year it should get back to $50 a share because it was $50 a share before. That really doesn't tell you anything. That's not a good way to value the company. It's gambling. That's all it is. And most people that I'm seeing get into investing are just gambling. So what you need to do is figure out. Sorry, radio's getting crazy here. But yeah, what you need to do is figure out the market cap, which any stockbroker is going to show you the market cap of the company. That's how much you're paying if you were to buy in now. And then you need to figure out how much that company is worth. There's a couple apps I use that help quite a bit. One is MacroAxis. If you just type in the stock ticker on there, it's going to give you just all kinds of information so that you don't necessarily have to go in and pull the balance sheet and read through all the information on there. They're going to show you how much money the company's made in the past, how much they're expected to make in the future, how much they have for debt, how much they have for assets, how much they have for cash in the bank. And I know I've kind of already gone through a lot of this stuff. I just want to really reiterate, when you buy a stock, don't buy it because the numbers might go higher for whatever reason. That is never going to give you any even educated guess on where the stock's going to go. What you want to buy it for is how much is the company worth as a company, not just the stock, not just the number that each share trades for. How much is the company worth? How much are you paying for it? And you should always think of it like you're paying the market cap. So in my illustration, if you're talking to your friends saying, hey, I bought a company with 9 of my other friends, you didn't spend $100,000 in the company, you spent $1 million. Your part was $100,000, but you spent $1 million in the company. And that's the way you need to look at it in the stock market. You paid the market cap, whatever that price is. Maybe you paid, if you buy a share of Apple today, you paid $2 trillion for Apple. That's what they're valued at. And then you need to look at their assets, their cash, their debt, everything else. Is the company worth $2 trillion? Is the company going to be worth much more than $2 trillion in the coming years, as you hold on to that investment? So that's really what you need to look at. And a lot of people don't understand this. They just look at the numbers. Well, the stock price is $10 and last year it was $20, so it's a good value. That tells you nothing. Nothing. The company might have taken a huge loan with high interest rate. The company might have lost part of their business where they're not making near as much revenue as they did a year ago. There could be any number of reasons that the company has gone from $20 a share to $10 a share. Just because it's fallen does not make it a good buy. And respectively, if it's going up, you could say, well, it's just going to keep going up. A lot of people will buy a company like Tesla or some of these companies that have just shot straight up. Facebook, they're going up. They keep going up. They've been going up for years. Why wouldn't they keep going up? Again, if you buy under that impression, you're gambling. That's all it is. You really need to know how much the company's worth, how much you're paying, and have some kind of educated guess as to how much it's going to be worth in the future. And that's really it. If you can understand, or at least get an idea how much that company is going to be worth in 5 years or 10 years, and that they're still going to be relevant and they're going to make all your money back in whatever number of years, that's going to tell you whether or not you got a good deal on the company. So don't think of it like you're buying a stock. Don't think of it like you're paying for a price or whatever that's going to go up. Think about it like you're buying a business, the whole business. Think of it like you're paying the market cap to own the entire business. And then you just need to know, are you paying too much or are you getting a good deal? And on a really good business, like Warren Buffett would use Coca-Cola as an example, the price that you're paying might be a fair deal. It's not necessarily a good deal. You're paying what the company is worth. The company, the PE ratio, Ford PE ratio, maybe 10 years from now, they're going to be this much. You can kind of figure out how much cash flow they're going to generate over the next few years. And this is going to tell you how much their fair value is. Now, when you're buying a good company, paying fair value might be just as good as buying a lesser company for super cheap. You might be able to buy that $1 million company that has $500,000 in the bank, and they're going to make $500,000 per year. And obviously, that's a no-brainer. That's going to be good money. But if it's a small company where that $500,000 a year isn't guaranteed forever, or there's a lot of competition or a lot of things that could happen that could lessen that money, they might not be as good as, say, buying a company like Coca-Cola or Amazon that's definitely got a strong market share that's not going anywhere for fair value. And then, over the years, they're going to last forever. They're going to keep going up. So there's definitely part of the valuation of your company needs to be name brand. If you're buying the biggest and the best company in their industry, odds are you're going to pay a higher price for it than a little bit no name. For using the Coca-Cola example, you're going to pay more for Coca-Cola than you would for Joe's Soda or some other off-brand company. The off-brand company might be making good money. They might have low debt, but you don't know where they're going to be in 10 years. because they don't really have the brand name recognition. They don't really have a built-in customer base like Coca-Cola does. And with Coca-Cola, you know, you're buying a safe company. You know, they've been around for years. They're going to be around for years. You and all of your friends probably know, I mean, everybody knows someone that drinks Coca-Cola products, whether it's Monster or Powerade or soda, whatever. They have so many products. So buying a fair valued company that's a very good, very recognizable brand, that's going to make you money long into the future. You just have to understand that when you're buying it, you're paying the market cap price, and you need to know whether that market cap price is a good deal or you're paying too much. That's really all there is to investing. I know that sounds easy, but it's really easy to look at the price and think, well, it's gone up or it's gone down, so it's probably going to do this or that. That's gambling. Don't do that. Anyway, if you have any questions or comments, leave them in the comments. I will answer everything I can. Or, I mean, you can hit me up personally too. This is still a new channel, trying to just share the information I've got out there. This is what I use to grow my portfolio over 200% this year in 2020. Thanks COVID, I guess. It has been an absolute wild ride. I got some really good deals on good companies with solid cash, just paid pennies on the dollar for them. And now as the economy recovers, the price has gone way back up. And yeah, my entire portfolio across the board today, I am up 215% since January 1st of this year. That's a good year. That's a good year. Most people don't, you know, even the professional investors, they're not making 200% in a year. So I'm pretty happy about that. So just stick to value the business, figure out whether or not it's a good business and you're paying a good price for it, and just understand you're paying the market cap. You're paying for ownership in that business. So smash that like button if you haven't already. Stay tuned for more videos. Subscribe to the channel if you want to see more. I'm going to try to get back onto releasing videos regularly. And until then, let's get rich.